The economy is always fluctuating, and many indicators can signal an impending recession. A recession is defined as 2 consecutive quarters of negative GDP growth. A shallow recession is typically characterized by a short period of economic decline and mild contraction in the GDP. While no one can predict with certainty when a recession will occur, it is essential for property owners and managers to be aware of the indicators that could signal an economic downturn. In this video, we will discuss several indicators of a shallow recession and how it will impact the multifamily industry. Indicators of a shallow recession. 1. Slowdown in job growth. One of the most significant indicators of a potential recession is a slowdown in job growth. If companies are not hiring as many employees, it can be a sign that the economy is slowing down. 2. Decline in consumer confidence. When consumers are feeling less optimistic about the economy, they tend to spend less. This decline in spending can lead to lower sales and ultimately lower GDP growth. 3. Inverted yield curve. An inverted yield curve is when the interest rates on short-term bonds are higher than the rates on long-term bonds. This occurrence can be a sign that investors are worried about the economy's long-term prospects. Impact on multifamily industry. During a recession, the multifamily industry is likely to experience a decline in demand for rental properties. People may be hesitant to move, and those who are currently renting may decide to move in with friends or family to save money. This decline in demand could result in a rise in vacancy rates, which would put downward pressure on rental rates. Managing in a shallow recession. 1. Stay up to date on market trends and indicators. Understanding the economic climate and being aware of indicators can help property owners and managers anticipate potential changes. 2. Focus on tenant retention. During a recession, it is more important than ever to keep existing tenants. It is much more cost-effective to retain a tenant than to find a new one. 3. Reduce unnecessary expenses. Property owners and managers should review their expenses and identify areas where they can cut costs without sacrificing quality. 4. Be flexible with leasing terms. Offering flexible leasing terms, such as shorter leases or rent incentives, can help attract tenants during a recession. 5. Communicate with tenants. Maintaining open and transparent communication with tenants can help alleviate their concerns and build trust. 6. Invest in property upgrades. Improving the appearance and amenities of a property can make it more attractive to potential tenants and improve retention rates. 7. Consider partnering with local businesses. Partnering with local businesses can help attract new tenants and build community goodwill. 8. Focus on property maintenance. During a recession, it is more important than ever to maintain properties to ensure they remain competitive in the market. 9. Diversify your portfolio. Investing in properties in different locations or with different amenities can help mitigate the impact of a recession on a property owner's bottom line. 10. Be proactive. It is important to be proactive in managing properties during a recession. Property owners and managers who take the time to plan ahead and anticipate potential issues are more likely to weather economic storms. In conclusion, while no one can predict with certainty when a recession will occur, it is essential for property owners and managers to be aware of the indicators that could signal an economic downturn. By staying up to date on market trends, focusing on tenant retention, reducing unnecessary expenses, being flexible with leasing terms, and investing in property upgrades, owners and managers can manage the impact of a recession and even thrive during difficult economic times.